Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Last week I said, and I quote, "So a significant move right from the start of this week, with consecutive closes below the bright green lower bull channel line of the imperfect mid-January to date bull channel. Will look like the market eyeing 2 weeks ago the resistance's top side of the 50% Fibonacci line of the May-August 2024 move at 630 and possibly the 50% Fibonacci line of the March to August 2024 move at 658. Well, they turned out to be prices taking fright at these and turning lower." End of quote. Now, prices dropped further down this week, down into a congestion zone stretching from about 540 up to 566, and seen between November last year to January this year, plus between late July to late August last year as well. This is where we have finally seen the market take a breather, amongst the purple declining neckline of the February to April reverse head and shoulders bottom, currently at 549. And the bright red lower time, currently 543, of the very shallow, breached, but still working up late August to mid-January bullish shift pitchfork, and a little above the 38.2% absolute Fibonacci line at 521. That supported the market back in August last year. Overhead we have a pair of moving averages close together, and to be honest, these did not provide much support on the way down and might not provide much resistance on the move higher. But they are still there, consisting of the flatlining green short medium moving average, currently at 567, and the very slowly declining medium moving average, currently at 570. What has been left behind in the wake of this market, ever since at least mid-January, and realistically could be seen as since late November last year, is a V-top as part of a larger bump and run reversal top pattern. Interestingly, the lower tine of the now broken late August last year to mid-January this year bullish Andrews pitchfork is at the appropriate angle for this pattern. And prices have last Tuesday reached the target below for the move down. We thus have support where we are, plus we're at the end of the bearish move. Question now is, will the market extend the move lower below this congestion between roughly 540 and 566 and below the bright red lower tine? It would seem that the market has achieved just about all its goals on a downside move, and it may be that prices are instead organising for a different pattern and a new move. Chicago corn. Okay, so a major move right on the go from this Monday last week. It was the end of the upwards move we've seen here since the start of the year. The key feature was the consecutive closes below the dark blue early December 2024 today uptrend, currently at 516, which was also the lower trend line in mid-January to late February ascending wedge pattern, as well as moving back below the significant 50% Fibonacci line of the June to August 2024 move at 505. Prices broke down further below the congestion band 491 to 498. The reason for this turn and fall lower were laid out by me 3 weeks ago when I said, and I quote, "We still might see further hesitation, as though the topside seemingly has limited resistance as the ones it does have, and there are two significant ones. They're likely to cause some second thoughts." You see, not far overhead we have the combination of October 2021 low and the 50% Fibonacci line of the June 2013 to February 24 move at 516. Then a little higher still, and we have another significant congestion combination of the 2014 high and the 61.8% absolute Fibonacci line, both at 525. These will be the levels to watch out for. End of quote. The fall last week pushed down through the green short medium moving average, currently at 483, which had been between September to December 2024 shown a significant support to this market, halting a decline and starting a rally. Then this week, below the bright red lower trendline extension, currently 462 of the slowly rising mauve medium moving average, all the way down to a fairly free zone till the flatlining gold long moving average at 441, where prices were stopped dead just short of it and pulled back up. The pullback up has been interesting as it stopped, so far at least, at the 38.2% Fibonacci line at 472 of the whole recent move down during the last 3 weeks. It's worth noting that this sees the market back up over the mauve medium moving average and the bright red lower trend line, though how good a support they might be is debatable, given how they acted only earlier this past week, their behaviour there. Now, 2 final points I thought about considering the action since late November last year as a possible bump and run reversal pattern, as we've seen in other grain markets, but after much pondering on this, I think this is not possible. My primary reasons are the shape of the pattern, it does not fit here, and the uptrend since early December last year is far too acute to qualify. Secondly, I've drawn a late November 2024 to early March 2025 bullish shift pitch hook for the recent move. I've chosen the less acute bullish shift pitch hook instead of the more acute bullish Andrews because the overhead middle time is for now, currently at 483, closer to the market than any other times, though I would of course morph this into the bullish Andrews pitch hook if it becomes appropriate. Kansas City wheat. Last week I said, and I quote, "Saw a significant move right from the start of this week with consecutive closes below the bright green lower bull channel line of the late January to date bull channel. What looked like the market eyeing 2 weeks ago the resistance topside of the January 2015 high at 646 and the early October last year at 632, the high of early October last year at 632, well, that turned into the market taking fright at these and turning lower," end of quote. Prices this week in the early part of the week continued lower, establishing the market under the combination of the mauve medium moving average, currently 576, the green short medium moving average, currently 581, the interesting and what seemed earlier possibly formidable bright red early December 2024 to date uptrend, currently at 578, that turned out to be not so formidable, as well as the unusual purple trend line, currently 571, of November 23 to April 24 descending triangle. Now remember this last one, this purple one, as it will crop up again soon. The fall continued during the early part of this past week, though congestion between 550 to 570 dating from November last year to January this year, but only stopped at the dark blue lower time of the very shallow late August to early January this year bullish shift pitch hook, currently at 543. This is a valid argument that you could remove, actually there is a valid argument that you could remove the shallow bullish pitch hook and just use the early December 2024 lows, especially the low closes in December 2024 as a support that finally stopped the decline. Something to think about. However, we can see that the overhead unusual purple lower trend line of the November 23 to April 24 descending triangle, that one I've asked you to remember, has capped the market's rise so far. In the overall picture, much like Chicago week, the market here has been the story of what has been left behind in the wake of the market's rise so far. In the overall picture, has been left behind in the wake of the market ever since at least early December last year, which is a longer period than in the similar period in Chicago wheat. Now what it is a V-top pattern that's part of a larger bump and run reversal top. However, here in Kansas City wheat, instead of the dark blue lower time of the now broken late August to early December 2024 bullish Andrews pitch hook providing angle for this pattern, instead we have the bright red uptrend as the trend line for this bump and run reversal top pattern. And here is the rub. The angle for this is too shallow. This leaves the opportunity for the pattern to still push further low with potential down to 543, which has already been achieved, but perhaps as far as 503, which would be below the significant 38.2% absolute Fibonacci line of 533 and just marginally above the unreconstructed December 1999 to date uptrend, currently at 502. Last week I thought the market had just about reached all its opportunities on the downside. This was presumptuous, as we've seen this week. Do I think there is still the opportunity on the downside? Possibly, but I once again feel, as I did at the end of last week's commentary, that, and I quote, the market has achieved just about all its goals on the downside move, and it may be that prices are instead organising for a different pattern and new move, end of quote. I might be wrong on this as well. but it will very much depend on the purple lower trend line above and on the 38.2 absolute Fibonacci below to determine that. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.